Hey investor friends, I'm McChellemarki, and today I'm going to share advice on how to not only preserve your wealth, but also to grow your wealth during stock market declines that are similar to what we saw in the 2000s after the dot-com bubble burst, and also with rising inflation similar to what we saw in the 1970s from renowned investors Ray Dalio of Bridgewater Associates and also Jeremy Grantham of GMO in a conversation that they had on May 9, 2022. And from them, we'll learn what they suggest we do. And you can decide if it makes sense for your personal portfolio or not. And if you enjoy content like this, I hope you'll consider liking and subscribing to my video and YouTube channel. And let's listen to them.
We live in an age where some much more important issues are playing out. And I know Ray shares that view to some considerable degree. But I view the stock market now really as a hobby. And the one thing that I have kept going is resources and climate change related investing, and also for old time's sake, investment bubbles, since I've been doing that for 40 or 50 years. And since I find myself unexpectedly in the third great investment bubble of my career, basically in the US. So I can't avoid it. And this is a wonderful day to be having this discussion. It's not only victory over Hitler in Russia day, but it's also a day where the market is showing signs of breaking down, and the other meme stocks are in ragged disarray. So this is the real McCoy, seems to be playing out pretty close to 2000. Always considered myself a fairly serious amateur historian. And what I've done in bubble territory is I don't try and build models to explain every day, as you guys do. I focus on the four great bubbles, which are characterized by nearly hysterical behavior, really seriously weird over-optimism, which is very rare, and which are characterized by accelerated price moves on the upside and by a weird deviation on the upside between the blue chips going up and the risky stocks going down. And that is rare as hen's teeth. It happened brilliantly in 29. It happened during the year 2000, again in spades, with the S&P X growth continuing to go up through September of 2000, and the growth stocks basically going down 50%, and the internet stocks dropping maybe 60, 70% by then. So that was spectacular. And we saw a very handsome deviation between the S&P rising last year and the Russell 2, for example, dropping quite handsomely. So there was a 20, 25 point spread on the upside. And that for me is a pretty good indicator. And I tell you what it describes. It describes Mr. Prince's "I've got to keep dancing because the music's still playing." And we understand that completely, the enormous commercial imperative of the industry to play up to and over the edge. But they're not complete idiots. And so they say, well, I've got to keep dancing, but I don't have to keep dancing with Pumatech, the most advanced stock in 99. I'm going to transfer to Coca-Cola. And I'll keep dancing off the edge, but I'll go off with Coca-Cola. And it works. The Coca-Colas may be handsomely overpriced, but in 1929 and 2000, 2001, and so on, they always go down a lot less as the bubble breaks. And that's the phenomenon that causes this very rare indicator of impending doom, which we saw last year. And so by early this year, it seemed clear to me that this was not only the real McCoy bubble, which had been clear for a year or so in terms of pricing and enthusiasm, but it had triggered this very rare indicator of impending doom, in other words, now. And so our piece of a year and a bit ago was called Waiting for the Last Dance. And our equivalent follow-up this January was let the wild rumpus begin, i.e., we're in it, dudes. And I do believe we are. And I believe the declines will be very substantial.
I think that looking at it year by year, this is the third year of the expansion with a very aggressive monetary policy. So we're in the part of the typical expansion where there's a lot of inflation pressures because it happened in a giant big way. And everybody's long, the world is it's the end of a paradigm because everybody believes that they want everything to go up. And of course, that creates a dynamic where policy is long, everything goes up. And of course, that happens by creating money and credit, and which creates debt. And that dynamic means that you must have a decline in real wealth measured by that, because that's the financial wealth has become enormous relative to the real wealth. Everybody who's holding bonds or assets, particularly the debt assets, believes, or financial assets in general, which are just journal entries, they're claims, but they believe that they can take that buying power and sell it and buy goods and services, and they can't. And by its necessity, there must be negative real returns, negative returns relative to buying power. So if we take it chronologically, I think there's the short-term cycle, which is usually the business cycle, takes 7 years on average, and give or take, depending on where you start the cycle, give or take a few years. I think we're moving along here quicker. So we're now going to be in a very tight environment, and that changes everything. So when we look at the returns of equities and we look at the well-being of companies, you see that the cost of interest relative to the expected returns of equities creates a squeeze on equities, changes the economics. A lot of borrowing has been done at much lower interest rates and so on. The return on equity for a company and versus the return, the cost of debt is changing, and all of those things are changing. And like all bubbles or paradigm shifts, the mentality that did exist, we don't have to worry about inflation, cash is a safe place, and so on, gets a shock. There's a punch in the face. There's been a 40-year bull market, and there's a punch in the face to all investors. We're going through it as Jeremy describes. And when that happens, things that were never supposed to happen, because everybody believes in the tech companies, and that, which is the same as the Nifty 50 or the .com companies, they get hammered, right? So like you say, 75% decline in Cathie Wood's funds and so on and so forth. That causes the adaptation. So we're in the beginning of that adaptation. That is most similar, I think, to the 1970s period. My main things are, first, cash is trash, and that there's in bonds and debt, it's not going to be good. And the claims of financial assets. So either avoid those or position yourselves so that when those things operate, and position yourself for inflation. So there are investments, lots of investments pertaining to inflation. I agree with Jeremy's comments about commodities. How do you create a truly well-balanced core portfolio? And we know that the typical well portfolio is not well balanced, with its greatest vulnerability being in that upper right quadrant in our box, which is the inflation box. And we know that we're in that environment. So from a starting point of view, I would encourage all investors to look at that those four quadrant box, that box that we have: rising inflation, falling inflation, rising real growth relative to discounted, falling real growth relative to discounted, and see what the biases are in those portfolios. I believe that now you can simultaneously reduce risk and raise returns, reduce risk of that portfolio by having more in that upper right quadrant, rising inflation, and you will reduce your risk, because if you look at your portfolio, typical investor's portfolio, that is the environment that it is missing. So you start with that. How do you get more neutral? How do you get better balanced? And you cover yourself from that exposure. And then you make your tactical moves around it. And the tactical moves, again, should not be in those debts. It should be very well diversified.
And when Ray Dalio is suggesting to allocate a little bit more toward the upper right quadrant of rising inflation, it looks like this matrix, where some potential assets we might want to consider investing in include things like inflation-linked bonds. So in an American example, this would be something like the Series I US savings bond, where we can currently get an interest rate of 9.62% that will change after 6 months, but that's the current going rate. And then there's also things like commodities like gold or silver. And then there's also emerging market credit, which I don't even know how one can invest in emerging market credit, but I'm sure there's some ETF or index fund dedicated to something like that. So definitely something to look into if you're interested in that. But I know that Ray Dalio is super bullish on the future of China and India. So if you can figure out a way to invest in those countries, whether it's in bonds or stocks or other kinds of businesses, then you might have something going for you there. So those are some things to consider. And also some of what Ray Dalio's all-weather or all-seasons portfolio asset allocation looks like is indicated on Tony Robbins' website, where perhaps a potential way to allocate your wealth would be to put 15% split across gold and commodities. But that's just one idea. I don't necessarily agree with that, but it's just one suggested idea of something you should consider and decide if it makes sense to you or not. And so some of my key takeaways from these distinguished investors and students of history is that per Ray Dalio, we could be seeing unpredictable political risk that will have huge economic and social ramifications, as well as per Jeremy Grantham, we're seeing declining populations and declining resource levels due to climate change, and also high debt risk, which along with the debt and equity bubbles that are popping, we could see substantial declines, as he said. And so even though Ray Dalio says cash is trash, I still like holding on to some cash per Warren Buffett. And then when equities decline some more, and when I think some wonderful companies are available at wonderful prices, then I look forward to investing even more. And hopefully they'll be able to recover someday as we go through some of the cycles that Ray Dalio has talked about, where we're currently in rising inflation, but eventually we'll see declining inflation or deflation, and then we'll see low growth, and then we'll be back to rising growth. So I definitely have hope for the future, and I hope you do too. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to investing well during this period of high inflation and also stock market crashes. So take care until next time.